Well, guys, it is chapter 2. Does anyone have any questions with anything we covered last week? The homework, the quiz? Any questions at all? Is it clicking? Okay. Is it making sense? So this week, can you guys hear me on the Zoom? We're going live and I'm hoping you guys can hear me.
Loud and clear.
Good. So we are going to talk about the first steps of what we call the accounting cycle. Now, this accounting cycle will cover chapters 2 and chapters 3. So we're going to talk about the beginning steps of the accounting cycle. Hang in there with me. And as I've said to you before, last week, if there is something that I'm not communicating well, please stop me and ask me questions. That's how I want this class to flow. I'm talking, but sometimes if you ask me to say it a little differently, it might click and make more sense to you. So I want you guys to do that. I welcome that. So one thing we talked about last week was the purpose of the financial accounting is to measure business activities. And we measure them by looking at this transaction and saying, okay, what accounts are being affected? Are they going up? Are they going down? What's happening here? We're going to learn this week how we're going to record transactions based on those business activities. And then we also talked about how we communicate those activities in the form of financial statements. Those financial statements put together all the different activities, and we prepare these forms so we can communicate to people who need that information in order to make decisions. So the first steps we are going to do for this week is we're going to find the source documents related to these transactions we're looking at. We're going to talk about what's going on here. What's an account that's being affected and how is it being affected? Is it going up? Is it increasing? Is it decreasing? Then we're going to learn something new called a debit and a credit. We're going to learn to record these transactions in a journal, post those transactions to the ledger, and then finally prepare a trial balance. So we have a lot to cover today. And again, you guys stop me if I'm not making sense. So the first thing we are going to do is talk about the transactions. Now we know there are various categories. We talked about the categories being assets, being liabilities, and being stockholders' equity. We've talked about these categories, but we know in each of those categories, there are various accounts that represent assets, such as cash, supplies, building, equipment. You know what I'm talking about? Automobiles. Those are resources. So in the big category called assets, we can come up with different accounts that are under assets. We can do the same with liabilities. With liabilities, we know most of them have the name payable with them. You're going to learn one this week that doesn't have the word payable with it. But liabilities are sacrifices, someone we owe money to. And then the stockholders' equity section primarily consists of common stock and retained earnings. Now, each company has their unique chart of accounts, their unique accounts they work with. So for example, in my office where I prepare taxes, I might not have the type of accounts that Anoka Ramsey is going to have because we operate and we use different types of accounts to process things. Okay. Target has inventory. I don't have inventory. Now the bookstore here has inventory, but that's about it. So every company uses those accounts that make sense to them that they work with. So we are going to now take each transaction and pick it apart and decide what accounts are being affected and how are we going to handle those. Okay. Okay, so remember this accounting equation that I told you last week was one of the most important things you were going to learn? The accounting equation always says that assets or our resources are always going to equal liabilities plus stockholders' equity. So we know when we're working on a transaction, if one side increases, then the other side is increasing. Excuse me, I've got someone who's financial accounting. Okay, so we're going to take a transaction and we're going to work with it. The first transaction we're going to take, good morning. The first transaction we're going to take on December 1st, we sold shares of common stock for $200,000 to obtain the funds necessary to start the business. Let's just think of this transaction. We sold to the public or to somebody shares of stock where we received $200,000. As the company, can you guys think of one account that's being affected? Any ideas? Has cash increased? Cash has increased, hasn't it? So one account that has been affected is cash. And what happened to cash? It went up, didn't it? Can you think of another account that could have been affected by this? Well, that cash was an asset, so yes, that was affected. But when we sell common stock, doesn't our stockholders' equity now increase? Our common stock now increases by 200,000. So you see, this one transaction, assets were affected by 200,000 and common stock under the guise of stockholders' equity was also affected. Do you see our assets went up? But then on the other side of the equation, our stockholders' equity went up. So do we still balance? We still balance, don't we? Sorry, guys, I'm struggling. It's so hard to talk and I'm learning. So at the end of this transaction, do our assets still equal our liabilities plus our stockholders' equity? They do, don't they? Sometimes it's tempting to decrease cash as a way of recording an investor's initial investment. However, remember, we account for the transactions from the company's perspective, not from the individual shareholder's perspective. The shareholder's giving up cash, but the company's receiving that cash, okay? Now here's another transaction. The other transaction is we borrowed $100,000 from the local bank and signed a note promising to pay the full amount of the debt in 3 years. What do you guys think happened here? Can you think? Hi, guys. So when we borrow money from a bank, let's just think of this. What happens when we borrow money from a bank? What do we get?
We get
We get
cash, so the
cash.
cash increase.
Cash increases. Good morning.
And
April.
liability does too. Good morning.
And the liability increases too, doesn't it? We now owe that 100,000 to the bank. So our assets increase and our liability increases. Okay. Do we still balance at the end? Do you see how our assets now are at 300,000 and our liabilities plus our stockholders' equity are also now at 300,000? Aren't they? We balance. Remember, after each transaction, the accounting equation must always remain in balance. In other words, assets must always equal liabilities plus stockholders' equity. Okay, guys, here's another one. We purchased equipment necessary for giving soccer training, 120,000 cash. What happens when we purchase equipment? What's one account that's being affected? What?
Equipment
Assets.
and then cash is being equipped. Yeah, assets.
Assets. So cash is being affected because it's decreasing, right? Isn't our cash decreasing? And then what else is being affected? What are we purchasing? Equipment. Equipment is
So it
also,
balance.
it's an asset. So do you see our cash went down 120,000, but our equipment increased 120,000? But guys, do we still balance? Yes. In that particular equation, it was on the side of assets. One went down and one went up. But we're still in balance, aren't we? Right? It's sometimes tempting to decrease cash as a way of recording. Oh, I put that in here twice. I'm so sorry. Okay. Hey, guys, what would be the effect on total assets if a company purchased land for 200,000 cash? What happens here? Who said C? You're right. There would be zero effect on total assets. Why? Because one asset cash goes up and one asset cash goes down and the other land goes up, right? But we're still at the same. Remember, for each transaction, the accounting equation must always remain in balance. Assets must always equal liabilities plus stockholders' equity. Get into the habit of checking this often. Okay? Now, guys, I'm going to tell you right now, this is something new that you've not seen before. When a company pays rent a year in advance, it's an asset because we now have a resource, the ability to use this building for one whole year. If we pay rent once a month, then it's an expense because it gets used up right away. But an asset is a resource that provides us with a future benefit. So when we pay a year's worth of rent, that is called an asset, and the account is called prepaid rent. This can happen with insurance. This can happen when we prepay advertising for a year at a time. It's when you purchase something upfront for a year. So it's not an expense because it's not getting used up in this month. Okay. So when we purchase 1 year of rent in advance for $60,000, we're decreasing our cash, but we're increasing an asset called prepaid rent. And we still balance, don't we? When we purchase supplies on account for $23,000, guys, we didn't pay cash for this. We purchased it on account. So what's going to happen here? Supplies is an asset. It's going to increase. But what is the other part of this equation, guys? Can you tell me what the other part of this equation is? When you pay on account, that means we haven't paid the bill yet. We owe them money. When we owe a bill, it's called accounts payable. We owe them money in the near future. So in this case, our assets increased by $23,000 and our liability, accounts payable, also increased by $23,000. But guys, we still whoops. Sorry about that. We still balance, don't we? One side went up, the other side went up. Now we're just going to add something additional to this. Do you guys remember last week we talked about retained earnings is a result of the beginning balance. We add net income to it and we subtract dividends to it. Do you remember that? So to broaden this equation, we know that revenues increase our retained earnings, and we know expenses and dividends decrease our retained earnings, don't they? So now when we're going to do some of these transactions, we're aware revenues ultimately flow back into retained earnings because remember, we add our net income into retained earnings. And what is net income? Revenues minus expenses, correct? So we're adding this piece in. We know revenues increase retained earnings and our expenses and dividends decrease our retained earnings. What happens, guys, when we provide soccer training to customers for cash? Do you see we got cash? So our cash increased $43,000, but we provided training, which means that was a revenue, right? That revenue increased our stockholders' equity through retained earnings, didn't it? Do you see that we still balance though? Our cash went up and our stockholders' equity went up. When we provide soccer training to customers on account for $20,000, this is a little different. We did the service, but they haven't paid us yet. Now, this isn't where we owe someone money, they owe us money. So in this case, here's a new account you're going to learn called accounts receivable. Accounts receivable is when someone owes the company money. Okay? If you think about it, if the company were to have provided a service with cash, cash would have gone up and service revenues would have gone up. But what they're telling us here is we provided soccer training to customers on account, which means we haven't gotten the cash yet. So we're going to still show it as an asset, accounts receivable. And we're going to show that revenue as stockholders' equity under retained earnings. Does that make sense, guys? Now, do you guys remember me telling you last week? Maybe I didn't. Maybe it was my other class. That liabilities always have the word payable except one. Here's the one that doesn't have the word payable after it. We received cash in advance for 12 soccer training sessions to be given in the future, $6,000. What this means, guys, is someone gave us $6,000, but we haven't done any work yet. We're going to give them 6 soccer training sessions. That's a lot of money for is soccer that expensive to be trained? I don't know. But for $6,000, they're going to get $500 per soccer training sessions in the future, 12 of them. So what has increased here? Our cash has gone up 6,000. But guys, this is a liability because we owe him something. We owe him soccer lessons. We don't necessarily owe him money, but we owe him a sacrifice, a future sacrifice we need to fulfill. That's why this is a liability. We never show revenues until we truly have earned it, until we've completed the service. Before we complete the service, this is a liability to us because we have to do something for them. So our assets went up 6,000 and our liabilities also went up 6,000. But guys, do we still balance? We still balance, don't we? Don't let the name fool you. Even though the term revenue appears in the account title for deferred revenue, this is not a revenue account. Deferred indicates that the company has yet to provide services, even though it has collected the customer's cash. The company owes the customer a service, which is what creates the liability. Now, we pay salaries to employees for $28,000. What is one account that is affected when we pay salaries? Cash. Don't we use cash to pay salaries? That's going to go down. But when we pay salaries, it becomes an expense, doesn't it? And we know an expense decreases stockholders' equity because it decreases the retained earnings portion, correct? So do you see, we still balance, don't we? Our assets still equal our liabilities plus our stockholders' equity. Who wants to take this one? What do you guys think happens here? We're going to reduce retained earnings because dividends reduce our retained earnings. So we know dividends are going to reduce, retained earnings is going to reduce via stockholders' equity. What else goes down when we pay dividends? Cash goes down. Do you see, guys, we still balance? Students often believe a payment of dividends to owners increases stockholders' equity. Remember, we're the company. The owners are receiving money, but we are reducing cash so we can pay them. And as a result, it reduces our retained earnings. Now, we have provided 10 different transactions. We have, these are the assets: cash, accounts receivable, supplies, prepaid rent, and equipment. Our liabilities: accounts payable, deferred revenue, and notes payable. And then our stockholders' equity, we have common stock and retained earnings. But we've realized that retained earnings, revenues increase it, expenses decrease it, and dividends decrease it. So guys, look, we still balance. Our assets still equal our liabilities plus our stockholders' equity. Who wants to take this one? While y'all are looking at that, can I just make sure Shandon, you're back there. Love your name. I accidentally called you Shannon and I fixed it. Austin, are you next? And then Brianna, and then Abby. Hey, Abs. Hunter, and then Joshua, and then Christina. Grant, is Grant here? Hassan? Sorry, I'm kind of hiding from you. Jesse? Jesse here? Jesse's online, I think. Alexander?
Yep, I'm here.
Alexander, anyone here? Iman?
I'm on Zoom.
Awesome, Iman. Marco? And then, what is your name? Mohammed. M-O-H-A-M-A-D? M-O-H-A-M-E-D. It's good to have you here, Mohammed. You weren't here last week, right? Okay, I'm just making sure I've got everyone. And then online, we've got Alexander, Angel, Iman, and Jesse. Is it going okay, guys? Iman, can you understand it pretty well?
Yeah, it's going really well.
Okay, and Iman, as long as you're on here, you're going to get all those solutions, you know, and just talk with me if this doesn't work. Just
Okay,
reach out to me, okay?
thank you.
So what effect does the payment of dividends have on the accounting equation? Think about it. What's being affected? Let's think of the two accounts that are being affected. What's one? Cash goes down. Cash is a asset, so it decreases. So we know assets decrease, but what else is decreasing, guys? Stockholders' equity is also decreasing because dividends decrease stockholders' equity. I already had that. Now, I want to share something with you, and I will tell you this can confuse people, but I am going to really help you understand so you don't get confused. A debit only means the left-hand side. A credit means the right. Do you see this T account? On the left, we have a debit. On the right, we have a credit. All debit means is left. All credit means is right, period. Now, some accounts increase when you debit them. Some accounts increase when you credit them. Some accounts decrease when you debit them. And some accounts decrease when you credit them. But debit means left and credit means right, and that's it, okay? Remember our accounting equation, how assets are on the left side of the equal sign? and liabilities and stockholders' equity are on the right of the equal sign. Assets, to increase them, you debit them because debits are on the left. Got it? For liabilities and stockholders' equity, to increase them, you credit them. And think about it. They're on the right side of the accounting equation. Therefore, you're going to increase with a credit. And the opposite is true. For assets, when you decrease them, you credit them. And for liabilities and stockholders' equity, when you decrease them, you debit them. I'm going to tell you something. It can be confusing. So it's really important you write this down. And so when you're doing your homework or when you're doing the quiz, you have that little sheet beside you. So you know, until it becomes normal to you, you know, assets increase with the debit, liabilities and stockholders' equity increase with the credit. Now, as we expand this equation, remember, retained earnings gets increased with a credit. Revenues increase retained earnings, don't they? So revenues will be increased with a credit. Expenses and dividends decrease retained earnings. When retained earnings are decreased, you debit them because it's on the right-hand side of the equation. Therefore, know that expenses and dividends have a normal debit balance. Guys, this is so helpful for you to just kind of have a, I hate to say the word cheat sheet because I'm telling you have sheets, but have this written down. So instead of you trying to figure it out in your head, you can go there until it starts clicking. Okay. Does that make sense? Okay. Here's an, oh, here, I'm sorry. I'll wait. Okay. Does everyone have it? Now, guys, this is helpful. DEALOR. If you look at the word dealer and you DEA stays on the left side, LOR goes on the right side. Do you see dividends, expenses, and assets have a normal debit balance? Liabilities, owner's equity, and revenues have a normal credit balance. That's another way to help you. Dealer, DEA, left side. LOR, right side, meaning dividends, expenses, and assets have a normal debit balance. LOR, liabilities, owner's equity, and revenues have a normal credit balance. But remember, debit means left and credit means right. Oh, what does the word debit mean? What's the word debit mean? What's the word credit mean? So now, all of these transactions we've kind of done, we're now going to revisit them by making a journal entry with debits and credits. So a journal is just the book we write these records in, these transactions. And the journal entry is this format we're using. Now, guys, all of this is computerized and done for us. However, we need to know how to do it. And I don't want to tell you how old I am but I will tell you my first job I had as an accounting supervisor at a mortgage company. All of this was done by hand. I had a huge account book a general ledger where we literally had pieces of paper we had to do this with. I know, it's pretty pathetic how far we've come. So, but you still need to understand how the process works. And we know with each transaction, our debits have to equal our credits, okay? So guys, let's go back to the first one. On September 1st, Eagle Soccer Academy sells shares of common stock to investors for cash of $200,000. We knew the two accounts we already had. We knew cash increased and we knew common stock increased. But now we can understand our cash we're going to debit. To increase cash, we debit it. To increase common stock, we're going to credit it. Okay. Remember to indent the credit amount. Do you see how common stock is indented? And do you see how the 200,000 is on the credit side? Make sure your debits go first. The names go first for all the debits. And then your credits go last. Now, when we post, the word posting is we take each one of these journal entries and we take the account and the amount, and if it's a debit or credit, and we post that information right to the specific account. So basically it's just transferring the debit and credit information right to the account. So this first transaction, we received 200,000 cash and our stockholder or common stock increased 200,000. The cash account, we will debit for 200,000. The common stock account, we will credit for 200,000. Next, when Eagle borrows cash from a bank for 100,000, our cash increases, so that means we debit it for 100,000. And our liability called notes payable increases. And since it's on the right-hand side of the equation, we credit it for 100,000. Do you see to post it means we just take that 100,000 and put it in cash, debit. And this notes payable, here's this account, we credit it for 100,000. Next. Oh, what they're trying to say here is instead of using these accounts, an easier way to do it is to use the account, but we call it a T account. We show our debits on the left and our credits on the right. Okay, it's the same purpose. We're just doing it a little different. Now, on December 1st, when Eagle purchases equipment with cash of 120,000, remember our equipment increases, but it's still an asset, and our cash decreases. Do you see? We put the debit on the debit side, but do you see with our cash, we credited it because it's being reduced, right? So after this transaction, do you see how our cash balance is now 180,000? It reduced, didn't it? Make sense? How's everyone doing? On December 1st, Eagle pays 1 year of rent in advance, 60,000. Do you remember prepaid rent was an asset? We debit it to increase it. Cash is an asset, but we're crediting cash because it's decreasing, isn't it? We're using cash. So after this transaction, our cash balance has gone down again to 120,000. You guys making sense? Is this clicking? Any questions? On December 6th, Eagle purchases supplies on account. Supplies is an asset. It's increasing. That's why we debit it. Whoops. Excuse me. That's why we debit it. We didn't pay cash for it. We owe them the money. So it's a liability, accounts payable. Accounts payable is increasing. Since it's a liability, when you increase a liability, you credit it. Remember, no matter what, at the end of every transaction, the debits need to equal the credits, okay? On December 12th, Eagle provides soccer training to customers for cash. Cash increased, therefore we're going to debit it. Our revenue increased, which increases our retained earnings, right? So we're going to credit it. Do you see how our debits equal our credits? When Eagle provides soccer training to customers on account, we didn't get the cash yet, but we debit our accounts receivable and we credit our service revenue. Our debits still equal our credits on this transaction, don't they? Remember this time they received $6,000 in advance for soccer lessons to be given in the future. We debit our cash because we've received cash, and we credit that new account called deferred revenue. That's really a liability. It's not revenue. It will become revenue when we complete the job. Then, when Eagle pays salaries to employees for $28,000, our debit is our salaries expense. We use cash to pay the salary, so we credit our cash. Same effect here. When Eagle pays cash dividends to shareholders of $4,000, our dividends are debited, our cash gets credited. So here is a listing of all the journal entries we've just done. Okay. And this shows every account. This is the posting. We took every journal entry and we posted it to the various accounts. Do you see, if we were to take our assets and show our cash balance, our accounts receivable, prepaid rent, our total assets will still equal our total liabilities plus our stockholders' equity. Which of the following is used to provide a chronological record of all transactions affecting the firm? The journal. Know this, they might ask you this on your quiz. And which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? What? Prepaid rent. Excellent. Prepaid rent, which is an asset, right? Now, we've done all of this. Finally, our last step is to prepare a trial balance. Guys, it's really easy. A trial balance is just mainly a list of all their accounts and their balances on a specific date. So it's only used internally, but it makes sure we're balancing. So for Eagle trial balance, we take all of our assets and we put them first, and they're all going to have debit balances. Then we take our liabilities and we know they all have credit balances. Then we take our stockholders' equity, the common stock, and retained earnings. And then the last piece we do is we do our dividends, our revenues, and our expenses. So the trial balance goes in that order: assets, liabilities, stockholders' equity, dividends, revenues, and expenses. But do we balance? Do our debits equal our credits? They always have to. Hey guys, which of the following accounts would appear in the credit column of a trial balance? Prepaid rent is what kind of asset? What kind of asset is prepaid? What kind of account is prepaid rent? It's an asset, so we know it has a debit balance. What are dividends? What normal balance is it? We know it's a debit because it reduces stockholders' equity. So to reduce it, it's going to debit it. Common stock, that's normally a credit balance, isn't it? So what I want to do now, for those of you who have a computer, you can follow along with me in McGraw-Hill Connect. For those of you who don't, you can write it out, but the computer really helps, guys, because we can go and work on it together. Okay? Okay, let's go to chapter 2's homework. And what I want to do, guys, is I want this to be a learning experience. I could just throw you all the answers, but I really want us to work together to try to see if this makes sense to you. So this first problem has us select whether the transaction increases or decreases assets, liabilities, and stockholders' equity. Leave it blank if there's no effect. The first example is issue common stock in exchange for cash. So what I do is I think, okay, what are the accounts that are affected? Cash is affected. Cash increases. I know cash is an asset, so an asset's going to increase. Also, common stock is part of stockholders' equity, and that's going to increase. Does that make sense?
Question? No.
I
Question.
want you guys to spend a couple minutes and attempt this, okay? Just attempt it. Remind me to restart the. So guys, purchase business supplies on account. What happens to our assets? They increase. What else happens? Liabilities increase. Do you see I can go and check my work? Okay. Any questions on that? Is it clicking? Does it make sense why our assets, supplies are increasing And then our liabilities, accounts payable increases. What about pay for legal services for the current month? When we pay for legal services, what do we pay with? Cash, and cash is an asset. So what happens? Does it go down? This decreases. What else is decreasing? Stockholders' equity is also decreasing. You can check your work. Do you see how you don't, if it's not being affected, you don't have to do anything with the category, okay? Next, provide services to customers on account. What's happening there? Your assets are increasing through accounts receivable. And what else is increasing? Your equity is increasing. Any questions about this, guys? I really want you to understand it. So say, and if you don't get it, most people aren't going to get it. So please help me. Okay. Pay employee salaries for the current month. What do you use to pay employee salaries? Cash. Is cash increasing or decreasing? Decreasing. A lot of times that's what I do, guys. If cash is involved, what's happening to cash? Then I kind of know how to figure it out. So when we pay employee salaries, what else is decreasing? Stockholders' equity through the salaries expense. Provide services to customers for cash. What's happening, guys? Cash increases. What else is increasing? Stockholders' equity is also increasing. Sorry, 1 second here. Okay. Pay for advertising for the current month. What's happening to cash? It's decreasing. What else is happening, guys? We know if assets decrease, something on the other side has to be decreasing, don't we? Isn't stockholders' equity decreasing because of the expense? Right? When we repay a loan from the bank, what are we doing, guys? We're using what? We're using cash. Is the cash increasing or decreasing? It's decreasing. What else? When we pay back a loan, what's decreasing on the other side? Our liability. We don't owe it anymore. It's decreasing. When we pay dividends to shareholders, what do we use to pay dividends? Cash. Cash is decreasing. And stockholders' equity via retained earnings is also decreasing. Okay, guys, number 10 says receive cash from customers in 4 above. So we had provided services to those customers on account, which would have been accounts receivable, right? But then what happened is they paid their money. They paid what they owed us. What's an account that went up? Cash went up. What went down? Accounts receivable. Isn't accounts receivable also an asset? So cash went up, accounts receivable went down. Did anything increase or decrease? No, we're going to leave that blank. And then when we pay for supplies purchased up here on account, when we pay with cash, it decreases, but our liability also decreases, doesn't it? We don't have that liability anymore. Okay. Now it says my answer is not complete, but I think it has to be. I did though. Nothing needs to change in it. Remember?
Number 6.
Oh, what do you know? Provide services to customers for cash. I needed to increase that. I'm sorry. Now it's complete and correct. But guys, do you see in number 10, you do not need to do anything with it? Okay. Any questions on this before we move on?
Number 2.
Number 2, this one again?
No, number 2.
Of course we can. But anything on this, guys, is it clicking? Do you kind of get it? Number 2. Again, I'm going to give you a couple minutes to attempt this. Guys, the reason I do that is so you see where you've gone wrong. You know, when you process it, you've kind of got your mindset, this is how I want to do it. And then when we go through it, you can see your errors. So I'm going to. So the first one here says provide services to customers on account for $1,600. When we provide services to customers on account, what does that mean, guys? Let's just pick it apart. We did a job, we didn't get the cash, but they owe us the cash. So what do we debit? Accounts receivable. And what are we crediting? Service revenue, which ultimately increases stockholders' equity, doesn't it? So do you see our assets increased and our stockholders' equity increased? Yes. Pay $400 for current month's rent. What's happening here? Cash goes down $400 and stockholders' equity goes down $400. Do you see what we do on one side, we have to do on the other if they're both involved? Hire. Okay, guys, this one is kind of tricky. Hire a new employee who will be paid $500 at the end of each month. That was an event that took place, but do we need to record that? No, we didn't pay him yet, did we? Nothing was affected there. Next, pay $100 for advertising aired in the current period. Cash goes down 100. Stockholders' equity goes down 100. Doesn't it? When we purchase office supplies for $400 cash, what's going up? Supplies are going up, aren't they? Supplies are an asset. They're going up 400. What's going down?
Cash.
Cash is going down 400. Both are assets. Do you see why they gave you those two spots? Because you're not dealing with liabilities and stockholders' equity with that transaction. One is going up and one is decreasing. One's increasing, one's decreasing. Does that make sense? Next, receive cash of $1,000 from customers in one above. What's going up? Cash. What's going down? Accounts receivable. Isn't accounts receivable an asset? So one asset's increasing, one asset's decreasing. Any questions on that? Number 7, obtain a loan from the bank for $7,000. Cash is increasing, 7,000. What else is happening?
Liability.
A liability is increasing 7,000. Number 8, we receive a bill of $200 for utility costs in the current period. Hey guys, here's a trick. Did it say we paid the utility bill? No, it says we received it. So we owe the money, but we haven't paid it yet. When we owe money, it's a liability, isn't it? Accounts payable. So won't that go up 200? And won't our stockholders' equity go down 200? Does that make sense? Issue common stock for 10,000 cash. What's happening here? Cash goes up 10,000. And what else goes up 10,000? Common stock. Now, number 10. When we pay $500 to employee in number 3 above, what are we doing here? What?
I'm not sure why.
Okay, think about it. When we pay, what do we do? Cash. Guys, that's what I always do. I always think, is cash involved? If cash is involved, I've got half of it figured out. And if cash is involved, does it go up or down? So when we pay a salary, cash is involved, it goes down. Okay? It goes down 500. And our salaries expense is part of stockholders' equity. That's also gonna go down $500. If we total these, 12, 11, 81, 18, 1, 17, 6. All right, let me just. Do you see, guys, our assets of 17,600 equals our liabilities of 7,200 plus our stockholders' equity of 10,400? Do you see how we balance? Any questions on this? How are you doing? You gonna do another one? This one actually, I want you to do on your own here. I want you to think about it. The key here is you need to know, is this an asset? Is this a liability? Stockholders' equity, revenues, or expenses? Okay. And then they want to know the normal balance. Remember that sheet I said is a great sheet to have near you? DEA, dividends, expenses, and assets have normal debit balances. LOR, liabilities, owner's equity, and revenue have normal credit balances. Let's take a moment and try to do this, okay? Salaries payable, what kind of account? Liability, and liabilities have a normal credit balance. Common stock, stockholders' equity. And it has a normal prepaid rent. And it has a normal debit. Buildings, utilities expense. Guys, remember with the word, with expenses, they will always have the word expense after it. Equipment, rent expense, notes payable, salaries expense, insurance expense. Oops. Cash, service revenue. And again, DEA, LOR, DEA, dividends, expenses, and assets have a normal debit balance. LOR, liabilities, owner's equity, and revenues have a normal credit balance. Okay. Okay. Now, this one, I'm going to do this one, and then I'll show you the solutions for the one after this. Jake owns a lawn maintenance company, and Luke owns a machine repair shop. For the month of July, the following transactions occurred. Now, here's the key. Record those transactions for Jake's lawn maintenance company. So we are the accountants for Jake. Jake provides lawn services to Luke's repair shop on account $500. What does that mean?
Is it a liability?
Yes, it's accounts receivable and it's service revenue, right? Right? So what are we going to say here? Accounts receivable. And for 500 and service revenue for 500. Always, you can go back and check your work. Okay. Next. The next one of Jake's mowers malfunctions. Luke provides repair services to Jake on account $450. What does that mean? One of Jake's mowers malfunctions. Luke provides repair services to Jake on account. Repair expense. Repair and maintenance expense. Remember, he he needed a service. And Luke provided it, but it was on account. So what are we going to do here?
Account payable.
Accounts payable. Because we haven't paid it yet, right? But we're going to, right? Then Luke pays $500 to Jake for lawn services that were provided on July 3rd. Remember back on July 3rd, Jake provided lawn service to Luke's repair shop for $500 on account. Now that it got paid, what are we going to do? Accounts, what are we going to debit first? What are we debiting? Cash? And we credit? What are we crediting? Accounts receivable. Because he owed us the money, but he paid it, so he doesn't owe us anymore. We're getting rid of it. Luke borrows $600 from Jake by signing a note. And we are recording them for Jake's lawn shop, okay? If Luke borrowed $600 from Jake by signing a note, what happened here?
Accounts payable.
Notes receivable, right? Because Jake is the one lending the money, right? Notes receivable, and he used cash to give him the money, right? Does that make sense? Okay. Next, Jake purchases advertising in a local newspaper for the remainder of July and pays cash of $110. What are we going to do there? Advertising expense, excellent. And what do we use to pay it? Cash, excellent. Next, Jake pays the Luke $450 to Luke for services provided on July 6th. What are we going to do? Go look at it, guys.
Is it cash and accounts payable?
Yes. So we will debit accounts payable because that's being debited. And we credit cash. Remember, we owed him money. Now that we've paid it, We don't owe the money anymore. Luke performs repair services for other customers for cash of $600. Guys, who are we doing tax, the accounting for though? Jake. So are we going to do anything about Luke here? No, we ignore it. I think maybe we can say no entry. No journal entry required, okay? Luke pays employee salaries for the month. Again, we're dealing with Jake. Luke pays $600 to Jake for the money he borrowed. What are we going to do for Jake? Accounts receivable is credited, but what gets debited? Cash. Cash gets debited and accounts receivable gets credited. So remember, what did I do wrong? Advertise, oh, because I have 100, not 110. Any questions, guys, on this? Do you see how you can check your work? Make sure you have it all right? What did I do wrong here? Oh, guys, thank you. You know what I did wrong? Instead of $110, I had 100 here. That's why I messed up. Okay. So I'll give these to you so you can see. Okay. Now the next one is the same thing, except you're only recording transactions for Luke. So you're going to maybe need to ignore certain things, right? Because you're not doing for Jake, you're doing for Luke that time around. Then what you're doing here, enter the impact of each transaction on the accounting equation. So here, we're going to do the same thing for Jake. Jake provides lawn services to Luke's repair shop on account $500. For Jake, he has an accounts receivable debit and he increased his service revenue. For Jake, we have to show he owes the money and it was an expense. Okay. So for each one of these, you can take your journal entries that we've already done and you can see, okay, if it's cash, it reduced our cash or increased our cash, but you can go and look at those and then fill them in here. Next, here is one I want to go through. This is where they ask you to prepare a trial balance. A trial balance is simply recording each account and then showing if it is a debit or a credit. We start with assets, then we go to liabilities, stockholders' equity, dividends, revenues, and expenses. So then what we will do is we start with cash, accounts receivable, supply. So I'll just do cash, accounts receivable, Supplies. Prepaid rent is 3,000. $40, $50, $1,100. 40, 50. Now I have them all here as debits because I know assets have a normal debit balance, right? Now the equipment, we don't know what that amount is, do we yet? Then we have a series of payables, accounts payable, salaries payable, interest payables, deferred revenue. What else? Notes payable. Now, all liabilities have a normal what balance? Credit balance. Then we've got common stock and retained earnings. And what balances do they have? DEA, LOR.
Credit.
Credit. Then our dividends have a normal what balance? DEA, debit. Then we've got service revenue, which has a normal what balance? DEA, LOR. Credit. And our expenses have what? 30, 12. Expenses have a debit balance. Salary, rent, interest, supplies, utilities. Salaries. Rent. Interest. Okay, now guys, how are we going to figure out what the equipment should be? Don't our debits need to equal our credits? And right now, how off are they? How off are they?
60,800.
Perfect. Wouldn't our equipment need to be 60,800? Does that make sense what I'm doing, guys? They need, if debits always equal credits, wouldn't the equipment need to be enough so our debits now equal our credits? Make sense? Okay. Next, you've got a whole scenario where you've got a November 30th balance. You've got these transactions for December. You're supposed to record each of these transactions. And then you'll post them to the T accounts and prepare a trial balance. So what you'll want to do, I'm going to go ahead and give you the answer to these so you've got them. Well, I've been having a lot of this happening to me lately. Okay, so for the chapter 2 homework, we went through a lot of these where I want to give you problem 8. I'm going to have you take pictures if you want. So yeah, because you're new here, you feel free to take pictures of anything I'm doing here, okay? I didn't mean you're new. You weren't here last time. Sorry. And then here's one. And then let me go down here.
You'll post this lecture, right?
I will post the lecture. You're right. I should have stopped by now.
No, so I can just,
You're
take a
right.
picture on my laptop. when I-
Yeah, you're exactly right. And then I'm gonna, here are the T accounts. Then the trial balance. Do you see how your debits have to equal your credits? Okay. Okay, now for the quiz. I'm gonna go ahead and turn myself off now, though.